So today is currently 5 June 2025, 7 minutes past 6. Let's get straight into it. So let's start with the Fibonacci, right? In terms of understanding it and how to use it. These are the settings you have to get. So yeah, hope you can see that. So when you set it this way, it's supposed to be this way. When it's bearish like this, let's do two examples. When it's bearish, so when it's bearish like this, when you draw it from, let me first start by drawing it on the actual chart. I'm on a daily time frame, but I'm just gonna show you in terms of drawing it. You're not gonna start on the wick down here and go all the way till the wick up here. Some people do that, but I don't agree with that. You use the bodies of the candlestick. So this swing high up here till the bodies up here, and as you can see, it highlights this daily order block that was here. You see, so you mark the highs, the lows. That's how you use it on the chart. Then understanding it on how it works is 100%. There's a 50%. I didn't mark the 50%, but there's 100%. There's an 80%, which is 79%. Then there's a 60%. Down here, you're gonna use 1, 2, 3, and 4. These, when it's bearish, it's 1, 2, 3, and 4. These ones. When it's bullish, it's 1, 2, 3, and 4. These ones. So starting from 0% till negative 27, till negative 62, till negative 100. These are your take profits. Take profit 1, take profit 2, take profit 3, take profit 4. Okay. Same thing here, 0%, negative 27, negative 62, negative 100. Take profit 1, take profit 2, take profit 3, take profit 4. It's that simple. It's that simple. Now that I've shown you how to draw it from where till where, let's look at it here, up here. I'm gonna take it from the bodies all the way till the top of these bodies, and here it highlighted this order block here. You see, highlighted this order block. It didn't quite tap in, but if you used the wick like this, if you prefer using the wick, it would have tapped you in, and you could be in right now, and you'd be targeting this higher. Let's use the Fibonacci one more time to see if it aligns with the take profits. Yeah, this would have been around take profit 2, closer to take profit 3, and the last take profit would be up here, or use this swing high. Your choice. Then let's talk about, I'm going to be explaining while reading notes that I did while watching ICT's videos. These notes are based on equilibrium, discount, premium. So let's start with, what is equilibrium? Equilibrium is the midway point of the price move. If you're looking for the daily, how do I put it? Let's go to the 15 minutes. Let me actually show you. So on a Monday, every Monday, you're gonna mark midnight as opening price. Tuesday, Monday, here. This is opening price here. Let's go to the daily. So what does this mean? How do we use this, and what does it mean? If price is in a bullish direction like this, which is buying up, as you can see, Supposed to be something like this, So when it's in a bullish like this means you mark Monday's opening price, which means you're looking for buys. Let's mark it from the monthly actually. And this is what you do when you swing. You start from the monthly, you mark the monthly low and the monthly high. Let's go back to the daily. So this means Monday's opening price, it's a new week, so this is actually perfect. And not a new week, a new month, it's a new month, so this is actually perfect. You're going to take your Fibonacci tool from the bottom down here, which is the trailing range. Remember, the bottom body till the top body, like this. We're down to the 4 hour. You refine it on the 4 hour. I'm a swing trader, so I enter on the 4 hour. And it's highlighting this 4 hour. Sorry, it's marking this 4 hour order block plus OTE, optimal trade entry. OTE, yeah. So Fibonacci, I didn't mark the 50%, but basically the halfway point between the 100% and the 0%, which is the 50%, that will be equilibrium, which is here. Opening price, it's already marked here. That will be the midway point, the halfway point, which is equilibrium. If you're bullish like this and you're looking for buys, you're supposed to look for entry points below the opening price. If you are bearish and you're looking for sells, you're supposed to look for positions up here above opening price, because you want to buy at a discount, you want to sell at a premium. Think of it this way: when something is expensive and it's too expensive, like the price is too high, you don't want to buy it. You want to sell, you want to short. But if something is very cheap, you'd rather buy it. Simple. Let's keep it that simple. Here is the liquidity that will be validating our point of interest, which is the 4 hour down here. For this coming week or the next coming 2 weeks, let me mark it like this. This is a market structure shift here. The market is changing direction. You see, and down here, liquidity was taken out. So now, this is what I'm expecting to happen. Something like this. Price is gonna keep moving, playing around here, and come down here, enter here, then move back up, and we're gonna be targeting the monthly high. And this is a swing setup. Stop loss right around here. And this is the setup. I'm not giving you a signal, I'm just explaining to the best of my ability. So in terms of the bias, the daily bias, we'll start on the weekly, on the daily bias. We're gonna mark the previous week's high. Previous week high and previous week low. Then we're gonna go to the daily. So We're gonna look at the weekly candlesticks. The previous week's candlestick was bullish, was bearish. It was bearish. Then before that, it was bullish. As you can see, a big bullish candlestick like this. So, if price closes below this candlestick, like if this candlestick were to close below, it's indicating a reversal. But now it did not close below. It was playing around just like in the middle. Let me mark this week's candlestick like this so I can explain it. Let's go to a daily. So when it's like this, this candlestick was bearish. Then this is somewhere the other candlestick here. Price failed to close below or above. It was playing around in the middle, which means that we haven't gotten a clear direction yet. But basically, this is where power of 3 comes into play. Remember how it works: accumulation, manipulation, distribution. Simple. Remember that. Power of 3, right? So let's go to a 15-minute. Let's start by marking out if only there was a if only bar replay was not on the paid plan. I would back test. I would be back testing. But let's start from this Monday here. Let's mark opening price of this Monday. Open price. Let's go back to the daily. Let's see how price was playing around that price we marked. So remember, below opening price looking for buyers, above opening price you're looking for sales. So here at this opening price, you can clearly see that it kept moving down, down. Then eventually it came till here. Let's use the Fibonacci to see what happened. Came till here, the 4-hour. This would have been our breaker. This is a breaker block. 4-hour breaker. This order block was in our OTE, and this was barely touched it. Barely. So this is the liquidity that validates the point of interest. And can you see where the point of interest is? Below opening price. You see. So I don't know if you can see this, but from here it was ranging. You see, accumulation. Then after this range, it swept, which was manipulation. After this manipulation was a distribution phase all the way till here. Okay, liquidity, I deleted by mistake, but you know where the liquidity is. So let's say you missed this entry and you're looking for a re-entry. We're going to do something like this. Move down to the 1 hour. And you would have gotten this 1 hour order block right here. So let's say you had entered here, stop loss. If it wasn't too tight, if it was too tight, it would have stopped you out. It would have stopped you out and kept moving till the weekly high. Weekly high, which was just here. So depending on your risk tolerance, if it was tight like this, it could have stopped you out, then you were out. Then it could have been something like this, maybe barely. So That's a very good thing to note. Your stop loss mustn't be too tight because it can stop you out, then go in your intended direction. So accumulation, manipulation, distribution. Let me see what else I have to cover. Okay, these notes are part of the 2016 Premium ICT Mentorship core content, and this is video 1. The title of the video is Elements to a Trade Setup. Then it goes on to say the idea is expansion, retracement, reversal, consolidation. Remember, accumulation, manipulation, distribution. Same thing. Then the reference points for order flow would be order blocks, fair value gaps, liquidity voids, liquidity pools, and stop runs, and equilibrium. What is expansion? Expansion when price moves quickly away from a level of equilibrium. So this opening price is equilibrium, right? So let me delete. I just want the opening price. Yeah, opening price right here. When price moves quickly away from it, like from here when it opens, this is the 1 hour. Let's use the daily. As you can see here, there was a huge move down before a huge move up. This is what is meant by a sharp move away from the equilibrium. And why is this important? So when price leaves quickly, this indicates willingness of the market makers to reveal intended repricing move, basically a reversal. What do we look for? We look for order blocks when it's like that. So an order block, you see this huge candlestick up. The previous bearish candlestick before a huge bullish candlestick, the body, not the wicks, the bodies like this. This is an order block. Simple. This is an order block. You go down to a smaller time frame. Top to down analysis, guys. You start on a higher time frame, moving down to your entry time frame. Right above it, liquidity. Right here, liquidity. So basically, that's what any point of interest, a fair value gap, an order block, a breakup block. Below or above those entry points, there has to be liquidity to validate it, or else it's just not solid. Like, look at this one here, and we're not using the Fibonacci right now. Look at this order block here. There was a huge move up and a small one here, and there was no liquidity. Well, there was a liquidity up here, but there's more liquidity residing down here than there is liquidity residing here. I don't know if you get what I mean. So let's move on quickly. So expansion. Let me do this. This is the illustration that I threw down when I was taking notes. So no man. So this is consolidation, right? Right here, consolidation. Then here, somewhere here, there has to be a huge move up, meaning this would be the the equilibrium here, moving away from it, right? Then here you'd find an order block or something here, right here. This would be your entry, and this is a reversal setup, not a continuation setup, guys. Don't see me doing it differently and think that I'm contradicting. This is a reversal setup, not a consolidation setup in terms of the power of 3. So that's the setup that I took. Doesn't matter if price moves upwards with a big candlestick. Last down candlestick is the order block, or last, or vice versa, same thing. Doesn't matter how fast it moves. The previous contradicting candlestick is the one that is the point of interest. Get me? Let's look for a retracement. When price moves back inside the recent created price range, that is a retracement. So let me look for it on the chart, actually, on the daily. Let's look for the daily. So if price has been bearish like this, you can see it's clearly moving up like this. So before it can't just keep moving up. There's no, the market does not move in one ways like this, up or down. It does not move like that. We both know that. There has to be at some point where price will do something like this. This is a retracement before it continues to the intended direction like this. So this retracement has to give you opportunity to enter before it continues wherever it's moving. Look, I was moving up, then retracement, created liquidity down here, back up, took out liquidity before moving bullish again. So this move here, this move here, 1 and 2, this is the retracement here. Can you see this is the retracement here? So this is the retracement, simple. Why is this important? When price returns inside a recent price range, this indicates a willingness to reprice to levels not efficiently traded for fair value. Basically, if this let's look at order blocks, right? What is an order block? How do you find an order block? Not an order block, a fair value gap. So here, when there is no wicks between here and here, you see how this body is formed. Also here, so where the wicks end and here, this is a fair value gap here. Up here, there's also a fair value gap here. See where the ends of the wicks are and stuff. Here, this is a fair value gap here. You see, so you see, this is why you use an OTE to find the right order block that is within the discount or premium zones using the Fibonacci, because wherever you look, there's order blocks everywhere, there's fair value gaps everywhere. Look, there's an order block here. This is an order block here. This is an order block here. Let's look at the fair value gaps. I showed you the ones this side. Here's a fair value gap here. Here's a small, but here's another fair value gap here. So wherever you look, these points of interest everywhere, it can be overwhelming sometimes. But that was a fair value gap. Simple. You use it the same way as a order block to find positions, but then I like using the 50% of the fair value gap most times, just to be safe, because it's just a huge space. On the daily, look at this on the daily. Let's say this far, this was going to be the 50%. You see this dotted line was going to be the 50% here. So I would have entered somewhere around here on the 50% like this. Then I'll target this high here. Just an example. Then stop loss around here, and would still be holding on to this position. You see, that's why you should know how to use the OTE, optimal trade entry. Then a liquidity void. Let me try finding a liquidity void. So you see here, when price was moving upwards, this part here, all the way up here, price did not have time to take out liquidity, as you can see, it left liquidity gaps 1, 2, 3, a lot. Then a liquidity void is basically when the market moves up or down aggressively. This is going to be pocketed where price wasn't actually delivered on every available price level. We wait for an indication of it getting long and try to find it in that range. So here, kept moving up, previous candlestick here, the wick, that's a void. This is a liquidity void. This is a fair value gap. You see, just for reference for you to see, basically.